Today we are going to discuss what is the best bank in Canada to get a mortgage. And the answer might actually surprise you because it's not just about who has the lowest rate. We will look at what each one does well, where they fall short, and which bank, in my opinion, is the best choice for most Canadians. We are going to compare Big Five: RBC, TD, BMO, CIBC, and Scotiabank, and rank them from the worst to the best based on prepayment privileges, penalties, structure and flexibilities, and how easy they make it for you to actually save money over time. Then I will show you one bank that clearly rises above the others. Let's start. Before the rankings, here is how I'm judging each one of those banks. Three main levers. Number one, prepayment privileges. That's basically how much extra you can pay towards your mortgage each year without paying penalties. So the more you can prepay, the faster you can become mortgage free, and the less interest you basically pay over the life of your mortgage. Our lever number two is penalties. So if you need to break your mortgage earlier, which a lot of Canadians do because you are selling, you need to refi, you are moving, you will have to pay penalties. And our lever number three is the structure. This covers things like, do they use collateral charges, which I will explain what it is, which makes it harder and more expensive to move from lender to lender. Do they have offers like home equity line of credit, mortgages? How flexible is the overall setup? So that's going to be our framework for today's video. Prepayment, penalties, and structure. Based on that, we are ranking them from the worst to the best bank. So let's start with number 5. My number 5 bank is RBC. Number 5 is the weakest of the big 5 for mortgages. To be fair, RBC is a fantastic bank for commercial banking, wealth, and investment. But for mortgages, they are at the bottom of my list, and here is why. They have the absolute lowest prepayment privileges. RBC only allows you 10% lump sums payment per year. So most banks actually at around 15 to 20%. On 500,000 mortgage at RBC, you can prepay up to $50,000 per year. With other banks, we are actually looking in between $75,000 to $100,000. It's literally twice that amount. That's a big difference if you're trying to pay off your mortgage faster. Con number 2, one-time use only. This is the kicker. RBC only lets you use that prepayment privileges once per year. So if you make a 30,000 lump sum in March, you cannot make another lump sum in December. So even if you still have that room in your 10% limit, most other banks let you make multiple lump sum as long as your stays within those annual limits. Another thing is the collateral charges, basically the home line. RBC's popular home line plan is registered as a collateral charge. Basically, that means you cannot just do a simple switch to another lender at renewal. You have to fully discharge and then re-register the mortgage, which can cost $500 to $1,000. It makes you very sticky to RBC. Great for them, not so great for you. Another thing with RBC is the high IRD penalties. Like all big banks, RBC uses IRD for their fixed rate penalties. If you break early, the fixed penalty can easily get to $15,000 to $30,000 depending on the rates on term that are left. If you break early the fixed mortgage, penalties can easily run between 15 to 30,000, depends on the rates and the term. So let's combine everything for RBC. So they have the lowest prepayment privileges, collateral charge on a key product, high fixed penalties, and that's basically my number 5. Let's move to our next bank, which is BMO. Number 4 is a Bank of Montreal. BMO is extremely solid bank and they do have some very good mortgage options. But they also have one product you need to be super careful within. Let's start with the good around BMO. BMO standard mortgage offers is 20% lump sum prepayment per year, which is perfect, 20% payment increase per year, which is amazing, and a mortgage cash account that lets you borrow money you have already prepaid. So that cash account is actually a great feature. If you aggressively pay down your mortgage and later need access to that money for emergency or big expense, you can actually pull that money back if you need it. So very few lenders offer that option. Then there is a BMO Smart Mortgage. On the paper, it looks extremely attractive. It does have a lower prepayment, it's around 10 instead of 20%, slightly lower rate, often 0.1 to 0.2% below the standards, and it has a bona fide sell clause. That clause is our biggest problem. You generally cannot break that mortgage or move to another lender unless you actually sell the property, in some cases refinance into another BMO product. So in practice, it really locks you with BMO for the full term. So if you want to refinance to pull some equity, switch to a lender for a better rate, maybe you need to clean up debt using some equity, you are super limited. You're stuck with BMO until you sell or your term is over. Basically, you have to stay inside BMO ecosystem. And if you try to break it, you will be facing hefty penalties. So if you're getting BMO mortgage, you want to be very sure you're not taking the smart mortgage unless you're 100% certain you won't need any changes. Okay, so let's go through the cons. Red line, their home equity line of credit, is also a collateral charge. They also have high IRD penalties on a fixed term mortgage, can be strict with self-employed borrowers. So for the BMO standard product, it's pretty good, but smart mortgage can be a trap. So a structure on a key product, that what puts BMO as my number 4. All right, so let's go into 3, which is CIBC. CIBC is stronger than RBC and it's stronger than BMO, but you still need to watch for a few landmines. So the great things about CIBC that CIBC does offer 10 to 20% lump sum prepayment. It's basically depending on the product that you take. Usually CIBC has decent rates and they also have up to 100% payment increase. That 100% payment increase is extremely powerful tool. If your payment is, let's say, $2,000 a month, you can choose to bump it up to $4,000 a month. Great if you get a bonus or your income jumps and you want to really pay off your mortgage fast. The thing about CIBC is their cashback trap. CIBC loves offering cashback mortgages. You will hear things like, we will give you $5,000 cash back at closing. Sounds extremely attractive. It sounds great, but there is a catch. If you discharge that mortgage early, CIBC will usually make you repay full cash back amount. So if you got $5,000 in cash back and you break your mortgage in year 4 or 5, you will own money back to ICBC. You will own the full 5,000. It will not be prorated like some other banks. Most other banks that offer cashback only make you repay a prorated portion based on the time that is remaining on your mortgage. IBC usually wants it all back. So if you take cash back from IBC, you need to be very sure you will keep that mortgage for the full term. Another thing is their home power plan, basically their home equity line of credit, is a collateral charge. Some products have lower prepayment, 10 instead of 15 and 20, and the bank also have high RRD penalties like the other big banks. CIBC has a strong payment increase option, but real traps with the cashback and collateral structure. That's why it earns number 3. All right, so let's go into our number 2 bank, which is TD, Canada Trust. TD is genuinely solid choice. They have strong technology, they had great customer service compared to others, and they competitive mortgage product. So TD offers 50% lump sum prepayment per year, basically standard across the banks besides RBC, 100% payment increase, excellent banking and technology, good programs for new to Canada clients, great programs for self-employed clients. I like that it does not play games on the prepayment side. Everyone gets the same 50%. You don't need to negotiate any special terms. And their tech really is the top tier among the big 5. So if you care about good apps, smooth online experience, TD is usually the best bank in that category. The main downside is their collateral charge. TD love to register mortgages as a collateral charges. They can register your mortgage for more than actually your loan amount, sometimes around 125% of your property value. So if your home is worth, let's say, $500,000, they might register a charge around $625,000. And if you only borrowed $400,000, what does it actually mean for you? You cannot get a second mortgage or home equity line of credit from the same lender. You have to basically stay with TD. Other cons, high IRD penalties on the fixed mortgages. And obviously they only have 15 prepayment, which is good, but it's not great. So TD is my number 2 for consistent prepayments, great tech and service, heavy use of collateral charges, which is basically is good enough for number 2. Okay, so let's go into our best bank. It's number 1. The best of the big 5 for mortgages, in my opinion, is Scotiabank. As a mortgage agent, I could place your mortgage almost anywhere, but I choose most of the time Scotia, and here's why. They have the best prepayment among the big bank. Scotia started mortgages usually comes with 15% lump sum per year. We can always ask for 20%. They have 15% payment increase per year. We can also ask for 20%. We can double up payments. The double up option is actually huge. Most banks give you either payment increase or double up. Scotia actually lets you to do them both. So if your payment is $2,000 a month, you can do both things. You can increase it permanently to $2,400 and occasionally double payment to $4,800. Very flexible if you want to crush your amortization. Another thing is Scotia often offers skip a payment option. So if you paid ahead, Scotia lets you skip a payment when you need money. It can be super helpful if you are self-employed with a slower months covering big expenses, or you wanting a short-term cash flow break. Other banks will have similar features, but combined with Scotia prepayment, it becomes super useful. And another thing is their STEP. Scotia's home equity line of setup is the STEP Scotia Total Equity Plan. It's one of the best HELOC structures in Canada. As you pay down your mortgage, your available home equity line of credit limits can be increased automatically. It's great if you are self-employed and you need access to cash, a real estate investor pooling equity, if you are doing cash damming, or you're planning renovations. Also, they have an adjustable rate mortgage. Scotia offers adjustable rate mortgage, not just fixed payment or variable. With an adjustable rate, your payment changes as the rates move, so you avoid negative amortization and adjust along the way. There is also subtitle bonus. Like most fixed rate mortgages in Canada, Scotia variable and adjustable mortgage are usually calculated with semi-annual compounding, not in advance. Some competitors use a monthly compounding on their variable product, same headline rate, but semi-annual compounding can mean you pay slightly less interest over the time. So basically what it means, if Bank A and Scotia quotes you the same variable rate, you're going to pay less with Scotia. Scotia is not perfect. If you port your mortgage and borrow more, they often create a second mortgage instead of blending. So you might end up with a mortgage one, let's say $300,000 at one rate, maturing in 2027, and the second mortgage of $100K at another rate, maturing in 2029. You just need to be intentional about aligning maturity days when you add money. And like all the big banks, Scotia still uses IRD for fixed penalties, so fixed penalties can still be large. But overall, among the top 5 banks, Scotia has the most flexibility in prepayment, great HELOC structure, adjustable rate option for variable mortgage, and solid overall design. That's why they're my number 1 bank.